My featured guest today, Peter Schiff, President and Chief Global Strategist at Euro-Pacific Capital, is the author of the best-selling book, Crash Proof, How to Profit from the Coming Economic Collapse, and his latest hit, The Little Book of Bull Moves and Bear Markets, How to Keep Your Portfolio Up When the Market is Down. Welcome back, Peter.
Thanks for having me again.
You know, I understand that you're on a business trip in California. I hope the weather is a bit warmer than the chilly East Coast mountains here.
It's actually one of the coldest days in a while out here in Southern California, but it's still a lot warmer than the East Coast.
I bet it is. You know, ironically, the governor, Arnold, just announced, I'm sure you heard, that his state is facing its own Terminator-sized fiscal problem. He declared an emergency with a special session to address California's $11 billion deficit. You know, without an infusion, California's government will soon run out of cash, and Arnold, well, he might not be back. This is becoming a common theme. Many cities are now begging the Treasury Secretary Paulson for funds. Atlanta, Birmingham, those are just two that come to mind. Do you think that the U.S. is facing a series of mini Iceland-like disasters?
Of course. Look, our whole economy is phony. I've been writing and speaking for years about the major fiscal problems that are going to confront the state of California because California has a bloated government. They have a lot of high taxes, but they're not even high enough to pay for all the services. And, you know, California was, part of the epicenter of the housing bubble, and so much of the California economy was related to housing and housing-related wealth and housing-related consumption that is all coming to an end. And a lot of the sales taxes and property taxes and income taxes that the state of California was able to collect, they were able to collect them as long as we had a housing bubble that kept everybody spending. But now that bubble has burst, the state of California can't meet its expenditures. And, rather than making dramatic cuts in spending, what they're looking for is a bailout from the government. As long as they're printing enough money to bail out Wall Street and bail out Detroit, why not print a few $100 billion more to try to bail out California? But, of course, California is not the only governor that's coming with a hat in hand to President-elect Obama. Everybody wants their piece of the action. And, of course, all the money is coming from a printing press.
Yeah, it sure is. So you expect then that Paulson will come to the rescue with his dollar-filled bazooka in one of Bernanke's helicopters then?
Yeah, I was watching Barack Obama's speech today, and he actually said that we just can't keep printing money forever. I wonder if he means that, or if but so far it seems that that's what they're going to try to do.
Yeah, please define forever, right?
They can't print it forever because it will have no value.
Peter, the inflation-deflation argument seemed to be put to rest over the past decade here against soaring precious metals, energy, commodities prices. But, in the past 6 months, the deflationist camp has emerged from its dusty cave waving the victory flag. Mises and Milton Friedman, they were both fond of saying that inflation is always a monetary issue. Yet, despite these numerous global rate cuts and trillions of dollars of bailout, inflation remains in check. Clearly, many of us underestimated the disinflationary effects that this massive credit crisis and hedge fund liquidations would have on the economy.
You're having people liquidating assets at very low prices right now, despite the fact that there is a lot of inflation. The inflation is still going on. Money supply is growing rapidly around the world. Now, credit is being destroyed. Sure, that's deflationary, but it's being replaced by new money that's being created. Now, it's not going to reflate these bursting asset bubbles, but it's going to show up in the real economy. It's going to show up in prices for both commodities and consumer goods. It's just right now, it's not. A good way to look at it is, let's assume as the recession unfolds, a lot of companies are going out of business. And so they have going out of business sales. And so temporarily, you have a lot of merchandise coming on the market at low prices. But once these companies go out of business, once they liquidate their inventory, and it comes time to try to replace it, it's going to cost them much more to do that, and they're not going to buy as much stuff. So when you get over the price declines, initial price declines that are happening despite the fact that there's a lot of inflation, once you get rid of that primary effect, the main move is going to be a much, much higher price level in the future, once we get rid of this liquidation. And that's what's going on.
But I'm sure you'd agree, though, that the money supply per se does include credit.
Credit is contracting. The government is creating money in the face of that. But the new money that they're creating is not going to go back into stocks and real estate like it did in the past. It's going to go into consumer goods, particularly when the U.S. dollar starts to fall. One of the reasons that we are not seeing as much of the effects of inflation is because the dollar has temporarily strengthened. But if you look at other countries, if you look at what's happening, let's say, in Australia or Canada, gold is making new record highs. So we're seeing the inflation show up in other countries where their currencies are falling. But temporarily, this crisis has caused a move into the dollar that is certainly unsustainable and will not last. But remember, the last time you had this deflationist camp that was in control was back in 2001 and 2002 when we brought interest rates down to 1%. Because everybody was afraid that there was going to be this deflation. Well, obviously they were wrong back then, and I think that they're still wrong.
You know, with record hedge fund redemptions and related margin calls, it seems the mad dash to cash is sending everything but U.S. Treasuries down to Davy Jones' locker.
Even yesterday, Ben Bernanke announced that the Federal Reserve would be specifically printing additional money to buy Treasuries. And that caused the biggest one-day rally in Treasuries, maybe in a long time, and it caused bond prices to go to record lows. But if you understand what's going on, printing money and buying bonds is the worst thing that can happen for bonds because that's pure inflation. And just because the government's going to be buying them, the fact that they're buying them by printing money is undermining their value.
But, most markets are following the major stock markets lead. I mean, I'm talking about commodities. You look at almost every asset class other than short-term treasuries. When do you see the markets divorcing themselves from this trend, and what signs should we be looking for?
It's impossible to tell. I mean, if I knew in advance exactly how it was going to happen, I would have been sitting in cash waiting for the opportunity to buy them, and I wasn't. I mean, I don't understand how things are going to be in the end. It's, I can predict exactly where we're going to end up. I just don't know the exact path that we're going to take to get there. So it's hard to say with any degree of certainty when this insanity is going to end. My gut feeling is it's not going to last much longer. I don't know if it's a matter of weeks, a matter of months. I don't think it's going to be years. I don't think the dollar is going to be going up for years. I just think there's too much fundamentally going against it for that to happen. But ultimately, I'm confident that when the dollar stops rising and when it finally starts to break down, it'll be a major, major collapse, and that the dollar's decline will be much more dramatic than the rally we've had for the past 6 months.
I'm sure you heard of last week's major terrorist event, which struck at the heart of India's financial capital city, Mumbai. The elite Indian commandos fought against Islamic extremists there in room-to-room battles. With over 200 killed, now the Indian news sources are blaming their neighboring country, Pakistan, for the event. With geopolitical tensions rising between the two nuclear-armed nations, some are concerned that a showdown of epic proportions could unfold. Are the markets factoring in the threat of a major conflict?
A major conflict would be another negative. I mean, whether or not it would work to the benefit of the dollar, I don't know. I mean, maybe it would, and maybe that would postpone these changes a little bit longer. But, of course, maybe